Today we're going to look at Bitcoin and how is it going with the prediction model for the Bitcoin correction. I'm also going to compare, give you some insight. Namely, we could ask the question, is Bitcoin the most predictable asset on planet Earth? I've been working with the financial industry, advising them, helping them to build various kind of models for advanced financial modeling. Did that for quite some years. And I can tell you I've never seen anything like Bitcoin. Just look at the current correction, for example, that we have fitted with a relatively simple model. It's based on this Ln function, which is the natural inverse of Euler's exponential. We will not geek out on the math, but you can see here the explanation degree 75%. I've often seen Quant working with 20% in R square, and that has been enough for them to do some sort of trading and being profitable. Bitcoin in this aspect is fairly unique. We have insanely high predictive values of the models we're using. With that said, there's no financial advice in this video, just me sharing my own thoughts, ideas, and other geeky stuff. Now, welcome to the channel. My name is Patrick, and you might ask yourself the question, well, if it's that simple, Patrick, why does it seem so difficult? Well, I didn't say it was simple. I said it was possible. It is predictable, or at least Bitcoin has so far, since its inception, been following some very simple predictive patterns. And right now, here you can see, and you can go back and look at previous videos. I said here on day 50 that I think Bitcoin will follow this line, which is based on this mathematical function, simply because all the other bear markets have been doing it. And what you're actually seeing here, if I just back up a little bit, is here is the top, and in yellow we have the Bitcoin data. This yellow line here is the predicted line, the model, so to say. Up here you have a confidence limit of 95% on the upper side, and then in red here on 95% on the lower side. And what you see here is the days from the top, simply because we will soon also compare with previous bear markets. And since the first one were in December and then in November and now in October, it's difficult to use calendar data here because things have started in different months. So I'm just using the number of days from the top to look at this model. And the reason why many fail, though, is that when you do this, the first one, the number one step, is to figure out what is the underlying trend, what is the underlying model I can build here mathematically. And from that, you do an analyze to figure out if the model is efficient or not. And that is called something residual analysis. So basically, I take the model value here and compare it with the actual value. So the predicted value compared with the actual value. And I look at the distance here. Here the distance is 0, they are totally on top of each other. Here this unusually large deviation from the predicted value to the actual value. And then you plot these residuals to see if they seem to contain pattern or be random. And if your model is explaining all the structure in the data, there should only be noise left, randomness. There might still be a little bit left you can do here by adding other functions on top of this model, but I will not cover that right now. What I will say, though, is that the number one mistake that most people do, is that they look at maybe the data here up and down, compare with some historical data up and down like this, or maybe they look at this section here is, I don't know, April, and here we have this month and that month, and compare with history. What you're doing then is essentially that you look at the residuals. And what did I say about the residuals? They're noise. So what you're essentially doing is that you take the noise of today, you compare it with the noise of the history, trying to predict the noise of the future. Does it sound like that will work? No, I don't think it does it? And it usually don't work, because it's so easy to find random patterns that seem to be kind of overlapping or kind of similar to the past. But most of the time it's just coincidental correlations. So number one, find the trend, look at the residuals. Do not analyze residuals, do not use the residuals to predict the future. Just look at them and try to figure out if the model you have is sufficient or not. We can also compare with previous bear markets. Here you can see also we have here green, the 2018 bear market, and in this red-orange kind of thing, the 2022 bear market. What I've done though is like in 2018 we went from like 1920k and down to 3000 or something. So what I've done is that I moved them so they all start at 126 where this top was, and then they move down in the same way, relatively speaking. So in that way we can easily see that if history was to repeat itself, we will end up here after 1 year between 20 and 30k in this area here. That is if history was going to repeat itself as last time. We can see that the prediction right now is that it will not repeat itself. It repeats itself in the sense that we can model it with a function based on Euler's inverse, but the way it unfolds is very different. And we can now say, with a statistical test where we compare this yellow line with these lines here, we can say that they are to 99% certainly different. This time is different. This time is not a repeat of the other bear markets we have had. These two other ones are quite similar, this one very different. And even if we will break this model and end up in the same place here, which I don't believe we will, but even if we would, we cannot say they were similar because this part that have happened so far has been different. So in that case, the rest of the part will need to be also very different to end up in the same place. But what is remarkable though is that all of them were so well modeled by a quite simple mathematical expression. And this has been the same also for the bull runs. They've been the most predictable thing ever. Then it turns into bear market, which also is the most predictable things ever. If you, for example, look here at the 24-25 bull run, look at the R-square. 90% of the variation in Bitcoin was explained by Euler's exponential. And as I told you, 20% is usually making a quant pretty happy. We have 90%. I've never seen an asset like this. And you can see the 99% confidence limit. And even though, of course, when we were in early days here and I had my first channel and draw these lines out, there is, of course, an assumption that the underlying fundamentals remains kind of the same. Otherwise, the model might break. But most often they do, and for Bitcoin they've done it every bull run and every bear market. We do have a deviation here. You see we go outside the 99% confidence limit, not for long, but did anything fundamentally happen here that can explain it? Yeah, the ETFs were launched, and that was quite a big thing. It never happened in previous bull runs, for example. And then the next time we start to break, the 95% is here at 100k, and then if we go over to 99% confidence limits, you can see that when we broke that, we could kind of conclude that, okay, the bull run is over, and we fell straight down here. The key takeaway is find the underlying trend line, remove the noise, and see through the noise. Do not use the noise trying to predict the future. Do not use the noise to try to find sporadic spurious patterns. With that said, thank you for watching today. Hope you liked it. Please comment, ask questions, say what you think, good or bad, and share and like and all those things. I hope to see you all soon again.